the agencies in Nigeria that are regulating the petroleum industry, right? I have quite a list here, about 4 of them. I would like us to go through them one after the other. The Nigeria National Petroleum Company, NNPC. NNPC, we are all very familiar with NNPC. Okay. What are the duties of NNPC? We'll be looking at the duties of NNPC. We'll be looking at why NNPC was established. Maybe I should start from there. What are the objectives of NNPC? Why was it established? Objectives. Let's look at the objectives of NNPC. All right. Now, NNPC was established as an instrument for accomplishing government's policy objective with respect to oil. Are you there? Accomplishing government policy objective with respect to oil. So I'll put here it was established for that. That was the purpose why it was established. Now, if that was the objective, what are their roles? What are their roles? What are their duties? So we'll look at NNPC again under duties. What are their duties? All right. One, the NNPC at inception was charged both with responsibility of engaging in oil and gas operation on behalf of the federal government and regulating the operation of the industry. But they have specific duties. They have specific duties. So what are these specific duties? I'll go through them. 1, exploring and prospecting for, working, winning, or otherwise acquiring, possessing, and disposing of petroleum. Did you get that? I'll go through that again. Exploring and prospecting for, working, winning, or otherwise acquiring, possessing, and disposing of petroleum. Okay? So that is one duty. Let's look at another point. Purchasing and marketing petroleum, its product and byproduct. That's another duty. Purchasing and marketing petroleum, its product and byproduct. Another point, another duty of the NNPC is refining, treating, processing, and generally engaging in the handling of petroleum for the manufacture and production of petroleum products and its derivatives. Did you get that? So, what else do they do? What else is their duty? Carrying out research in connection with petroleum, all right, or anything derived from it. So they are also involved in research as far as petroleum is concerned. Did you get that? Another thing they do is constructing, equipping, and maintaining tanks and other facilities for the handling and treatment of petroleum and its products and derivatives. Derivatives are things that comes out from petroleum, something like your Vaseline jelly, your cream, Vaseline jellies from petroleum. The petroleum has byproducts. All right. Generally, they engage in activity that will enhance the petroleum industry in the overall interest of Nigeria. So those are the duties of the NNPC. Okay, we've gone through them. So let's look at the other one here. We want to look at National Petroleum Investment Management Service, NAPIMS. NAPIMS have a slight challenge here. This actually should be part here, right? So I'm going to write it out. Management Services, and that is NAPIMS. So who is NAPIMS and what do they do? Okay. NAPIMS is the upstream arm of the NNPC. NAPIMS is the upstream arm of the NNPC. Okay, and they oversee the government in the joint venture producing companies. Are you there? So they represent the government in the joint venture producing company. Remember, we talked about joint venture somewhere there. All right. The production sharing companies contract and the other one, risk service contract. NAPIMS is also engaged in exploration services. Are you there? They are also engaged in exploration services. Basically, their role, their duties are to maximize petroleum profit tax. To maximize petroleum profit tax. I think I should put that there. Maximize petroleum profit tax. Petroleum profit tax. Okay. Maximize petroleum profit tax. And guarantee a high rate of return through efficient cost reduction scheme. And guarantee a high rate of return through efficient cost reduction scheme. They also ensure that a reserve base is maintained and that reserve targets are met. All right. For the Department of Petroleum Resources, they actually took over the activities of the former Petroleum Inspectorate Division of the NNPC. Okay. The DPRO is charged with the supervision of all operation. They are charged with supervision of all operation. They are in charge supervision, okay, of all operation. Right? All operation carried out under the licenses and lease in the petroleum industry. The DPRO is generally known as the agency that registers all company. That's the agency that registers all company seeking to carry out business in the oil and gas industry. Right? And you know what that means? Usually, they register companies, all your fuel stations, petrol stations, has something to do with the DPRO, Department of Petroleum Resources. Okay? So, I think that's okay with the regulatory agencies. So far, so good. Sector, although we have dwelled on two of these items before, remember, we have talked about production sharing contract. Okay, we've talked about production sharing contract. This is where we are supposed to have talked about that, but we've talked about these ones already. So basically, I'm going to look at these two, this and this for now. Joint venture arrangements. Joint venture arrangement. What is it? What is this all about? Okay, what is the joint venture arrangement? Of course, there are two types. First, we have to know that there are two variants of this arrangement. Of course, it's an arrangement, but there are two types. So let's look at the two types. One, we have the one. It is equity share participation arrangement. Equity share participation. Okay. And then what about the second one? The second one is non-equity share participation. Before we now try to see what they are all about. Non-equity share participation. So what are they all about? What is it about? So we'll now go through them one after the other. For equity share, under this arrangement, I mean, a separate legal entity in the form of a limited liability company is formed by a multinational company and the federal government through its agency. Are you getting it? So joint venture. So the multinational and the federal government will now form an entity, a limited liability company. The new company now draws, as may be agreed, from the financial and human resources of the shareholders. Did you get that? So this company is like the middleman. There's the federal government on one side, the foreign company on one side, two of them coming together to set up a company, and this company will now get its resources, both human and otherwise, from the two shareholders, that's the federal government and the foreign company. Okay? The management board representation of the company is usually based on the party's equity interest in the company. So the board depends on the equity of the two persons, that's the federal government and what do you call it, the NNPC. NNPC, federal government and the foreign company, okay, through NNPC. So NNPC represents the federal government, and then the foreign company also will be there, okay. Most of the companies that fall into these categories are service companies, and then the NNPC, what is their share there? The NNPC acquired 36% equity or more, right? Acquired 36% equity or more in most of these service company. Are you there? So that is what the joint venture JV arrangement is all about. It was one of these arrangements that led to the formation of the Nigerian Liquefied Natural Gas Company, NLNG. Remember? So that is that. Let's look at, okay, I said we have looked at the production sharing contract before. Let's go back to where we talked about it. Let me confirm that. We did talk about it here, production sharing contract and the risk service contract. So go through that tutorial. You will see what, you will hear what I have discussed on that. This other point here is actually not an arrangement, but I think we should just dwell on it. Sorry, we're looking at oil and gas trade zone. The federal government established what we call the oil and gas export free zone. Okay, oil and gas export free zone. All right, and that is OGF, sorry, oil and gas export free zone. What is this zone about? What are the incentives available to this zone? All right, so that's what we'll be looking at for the zone. Now, it was the act that established the zone was Act number 8 of 1996. Act number 8 of 1996 established an oil and gas export free zone. All right. Now, the incentive available to enterprises was just an incentive kind of thing, trying to give incentive out to enterprises that are operating within this zone. Okay. There were certain incentives that were given to them that were available to those that operate in the oil and gas export free zone. What are they? They include the following: all approved enterprises shall be entitled to import into the zone free of custom duty. Did you get that? Any enterprise or company that is within that zone, okay, the area that are declared as oil and gas to, export free zone, companies there can import free of duty, custom duty, capital goods, customer goods, consumer goods, raw materials, component or articles to be used in carrying out an approved activity, or for construction, alteration, reconstruction, extension, or repair. What happens here is this. This is why when we are talking about tax planning, we said that persons should invest intelligently. This is one of the areas. Businessmen could take their businesses, their business premises, could do business in the oil and gas export free zone, because they stand to benefit, they stand to enjoy this incentive that is given to those zones. All right, this is one of them, that you can import goods free of charge. You don't pay custom duty. Okay, What are the other types of incentive? Approved enterprises operating within this zone shall be exempt from all federal, state, and local government taxes, levies, and rate. Did you get that? So that's a very big one. That's a very big tax benefit there. Companies there will not pay tax, right? Legislation provision relating to taxes, levies, duties, and foreign exchange regulation do not apply within the zone. Remittance of profit and dividend earned by foreign investors in in the zone, it's done easily. So this zone, this oil and gas export free zone, was actually meant to attract foreign investment. Was actually meant to attract foreign investment. That's why government came up with these incentives, so that investors could come in and develop our help in developing our economy. Okay. Period. Basis of assessment. Remember in the lecture on basis of assessment, I told you that you will need the knowledge of basis of assessment in virtually all the topics that you'll be coming across in taxation and even advanced taxation. So here we are. On what basis will the petroleum company be assessed? On what basis? This is what we are talking about here. There are three ways the petroleum company can be assessed. One, it's either from the first day of the year, from the first day of January to the end of that year. To the end of that year. That is one. That's assuming the accounting year end is 31st December and the business commenced. The petroleum company commenced business in first day of the year. Okay. The other one is that supposing it did not commence in the first year of the year, maybe it commenced somewhere around July, right? For that year, we are going to assess that petroleum company from the day he makes the sale of bulk disposal. Okay, that's the day we assume that he started business. From the day he makes a sale of bulk disposal, all right, to the end of that year, and then where the company is seizing, from the first day of the year to the day it ceases. So it's more or less basis of assessment we did in tax. If you remember those things, from the first day the business started to the end of that year, first 12-month accounting period, ending in the preceding year based and all whatnot. So this is a replay of those issues now. Okay, so we move on to see the next point here is sources of income. Sources of income. I think we are going to spend some time here. Sources of income. How to calculate, how to compute this income there. We are looking at the sources of income of a petroleum company, and we have four of them. From the sale of crude oil, all right, chargeable oil disposed, natural gas sold, and other income. So here we go. Proceed of sale of crude oil. What's the meaning of that? The proceed of sale of crude oil is obtained by multiplying the number of barrels produced by the selling price. So I can come here and say is equals to number of barrels produced, okay, multiply by selling price. The selling price here is in quotes, so we need to explain what selling price is. It's in quotes. Now the selling price shall be the higher of actual selling price and adjusted posted price. Selling price again is equals to higher of, are you getting it? Higher of actual selling price. So there's something called actual selling price. There's another one called adjusted posted price. Actual selling price, okay, right? And the adjusted posted price. So what's adjusted posted price? We need to explain that again. Adjusted posted price. Adjusted posted price or posted price itself is the price free on board of crude oil of a given quality. Can I find a space to put that? I think I should do that here. Posted price. Posted price, right, is equals to, as much as possible, price, right, free on board of crude oil of a given quantity and quality and gravity of a given quality and gravity. Okay, so it is usually an agreed amount between the federal government, that is the NNPC, and the petroleum company. Okay, such agreements will provide for what? Will provide for adjustment in the posted price. That's why we come about adjusted posted price. Okay, depending on the gravity of the oil at the point of production. After adjusting the posted price, then the adjusted posted price will be used in computing the proceeds of sale. Okay, so that is that. We will appreciate this. I will bring in question. I will bring in a question that we have to show us how to arrive at this. Okay. Now let's look at value of chargeable oil disposed. Value of chargeable oil disposed. This one is relevant. It's relevant where the petroleum companies engage in refining, and the petroleum company supplies its refinery with crude oil. Are you there? The value of chargeable oil for the purpose of computing tax is the aggregate of the following. Did you get that? So in this case, one, there's a refinery, okay, and the refinery is being supplied crude oil. The company supplied refinery crude oil. Supply of crude oil. So we are now saying, what's the value of chargeable oil? The crude oil that is taken to the refinery, right, is what we see as a chargeable oil. And it's made up of a component, right? One, the value of the oil for the purpose of royalty. The value of the oil for the purpose of royalty. So you are going to bring in, under exam condition, if you want to compute your value of chargeable oil, you first bring up the value of oil for the purpose of royalty, if you have it in the question. All right. Cost of extraction of the oil. Cost of extraction of the oil. The cost of transportation and storage. The cost of transportation and storage. Cost of maintenance of pipeline. By the time you aggregate these four items, you will be having the value of chargeable oil disposed. Okay? And there is some technical aspect here that we need to talk about. We need to talk about this. For the value of oil for the purpose of royalty, the first one is obtained. That one, the value of oil for the purpose of royalty, is obtained by multiplying the number of barrels produced by the APP. What is APP? Adjusted posted price. After adjusting the number of barrels produced with internal usage by the company loss through evaporation and return to the field of operation for production. I think I would like to put down that your value for the value of oil, value of chargeable oil, the value of chargeable oil. Okay, sum up the following. I think this will help. Sum up. 1. What are you? Oil for royalty. Oil for royalty. Sum up 1. Oil for royalty. So I'll come down and put, where is it? Oil for royalty. Oil for royalty. Royalty. Bring that in. Cost of extraction. 2. Cost of extraction. You will be given in the exam. Cost of extraction. 3. Cost of transportation and storage. 3. Cost of transportation. Transportation and storage. Okay, bring that in here. Number 4. Number 4 is cost of maintenance of pipeline. Cost of maintenance of pipeline. Sorry, I will have to go this way. Pipeline. Bring it up. So when you add all of them together, what you have is value of chargeable oil. Value of chargeable oil. What of importance is this first one here. This one. This is what I'm going to further analyze or bring down. That the value of oil for royalty is gotten from this formula. Okay? Q quantity minus Q1 plus Q2 plus Q3. Okay? Multiply by APP. What is Q1? Q1 is actual quantity produced. Q1 is actual quantity produced. Q1 is equals to actual quantity produced. Okay. Q2. What is Q2? Q2 is equals to return to the field. Oil that was returned to the field. Sorry, what am I saying? Q1 is returned to field. Q1 is returned to field. We need to correct that. Q1 is returned to feed. Q1 is returned to feed. While Q is the actual oil produced. Q1 is returned to field. Q is the actual oil produced. So Q1 is returned to field. Q2, what is Q2? Internal usage. Internal usage, the oil that was used internally. Internal usage. All of this you can pick from a question. Q3, evaporation loss. The one that went through evaporation equals to evaporation loss. Evaporation loss. So this is how you will use this formula here, this formula, to get your oil for royalty. Okay, so that is that. All right.